Here's a wild fact to kick things off. In 2008, the U.S. government handed American International Group, AIG, $182 billion. That's the biggest bailout in U.S. history. Not a bank, not an automaker, an insurance giant. Ever wonder why? Let's crack into the hidden deals behind a global collapse. AIG wasn't your everyday insurance company. In the years before the crash, they dove headfirst into risky financial products called credit default swaps. Basically, insurance policies on mountains of mortgage loans. Trouble was, AIG sold way more of these than they could ever hope to pay out on if things went south. And then, the housing market imploded. Suddenly, everyone wanted their insurance money at the same time. AIG couldn't cover it. In a flash, their credit rating tanked, and even more investors started demanding cash. Money AIG just didn't have. The government stepped in with an initial $85 billion lifeline, grabbing nearly 80% ownership of AIG overnight. But that was only the beginning. As the crisis deepened, the total commitment ballooned to that mind-blowing $182 billion. Why save them? Because if AIG fell, their collapse would have gutted major banks worldwide, Goldman Sachs, Deutsche Bank, others, sparking an even bigger meltdown. Here's where it gets controversial. A huge slice of the bailout, about $62 billion, went straight through AIG to pay off these banks in full. In finance circles, folks call this the backdoor bailout. Taxpayers basically rescued Wall Street's biggest players. No haircut, no shared pain. People were furious. Critics said this rewarded reckless risk-takers and set a dangerous example. If you're big enough, the government's got your back. No wonder "too big to fail" became a household phrase. So what happened next? AIG sold off massive parts of their business, whole companies in Asia and Europe, to pay us back. The government slowly sold its shares, and by 2012 taxpayers were not just repaid, but actually made a $22.7 billion profit on the deal. Still, the damage was done. The Dodd-Frank Act rolled out in 2010, aiming to keep this from happening again. But here's the kicker. Today, some banks are even bigger than they were before the crisis. The too big to fail problem? Still lurking. AIG shrank down, refocused on insurance, and just last year sold more of its old business to Everest Group as part of its ongoing cleanup. So is the system safer, or did we just patch up the cracks? The debate isn't over. If you want more untold stories from the world of finance, hit subscribe and stick around. There's always another secret to uncover.